In any domain in life, we have a large number of people at the base and a very small number of people at the top. That seems to be a rule of hierarchies, and it appears to follow the Pareto's distribution. Some will say that this unfortunate feature of hierarchies is a human invention, but as it turns out, this happens in nature as well. Vilfredo Pareto, an Italian economist, observed this mathematical feature of nature when he observed that 20% of pea pods produced 80% of the peas in his backyard. The rise of alpha males in chimp hierarchies is another example. A chimp tribe will have one male that commands and has the most power. This can also be observed in trees, for example. Within a given species of trees, most trees will have generally the same height, but a small number of trees will be much taller. Without a shadow of doubt, financial markets are not an exception to the application of the Pareto's principle. In fact, financial markets are the representation of the Pareto's principle on steroids. We have a huge number of small retail traders and a very small number of super powerful large traders, banks, and institutions. However, the substantial cause of the market, which are the traders' expectations, can be legally manipulated by powerful players, making use of the inherent features of the supply and demand mechanism of the market. The paradigm is that many retail traders think in a similar way, which makes their moves very predictable. In that way, powerful players can nudge price at specific points to push retail traders off the cliff, metaphorically speaking. In any given market, there is a positive feedback loop that catapults the successful ones to more success, and a negative feedback loop that maintains the unsuccessful where they are. Another way of thinking about this is that a positive feedback loop is self-amplifying, and a negative feedback loop is self-corrective. This is not a feature of markets or corrupt human hierarchies. It happens all over nature and in very fundamental biological structures that are morally blind, so to speak. Knowing this sort of thing can be useful because we can identify a pattern in the way market makers act, and this pattern can be exploited. The pattern goes like this. The von Riestorff effect. Large traders increase volatility near a high or low to induce retail traders for a breakout trade. This is usually where we can see orderly behavior because they must do this artificial volatility increase in a systematic way. The reverse psychology. The high or low in question is pierced just enough to trigger the retail traders' positions and create a burst of liquidity for large traders to enter the market in the opposite direction. Large traders push retailers to one side just so they can induce them to the other side right after. The only goal of this is to take advantage of the liquidity burst resulting from the order cluster being triggered. The bandwagon effect. Since retail traders have had their stops triggered and they are seeing the market go in the opposite direction, they simply jump on the bandwagon to recuperate their losses. This helps to push the large traders' position to their desired direction. This pattern relates to what I mentioned about positive and negative feedback loops in the market. Market makers in the process display a positive feedback loop because they make large profits, and the retail traders display a negative feedback loop because they get in and out of the market and make no profits or usually lose money when subjected to this type of market manipulation. However, being aware of how it happens might give you the opportunity to be part of the positive feedback loop instead of being sucked back into your starting position in a negative feedback loop.